Thank you. Mr. McCotter.
Thank you, Mr. Chairman. First, just a quick note. We heard much talk about the Wall Street Reform Bill, and we will continue to. And it was said that the bill is bipartisan and that the nature of that should not be overlooked. I'd just like to point out for the record that the bill is so bipartisan it's called Dodd-Frank. Mr. Bernanke, thank you for being here today. In your testimony and your written remarks, there are some things that coming from Michigan, a very hard-hit state that is struggling to come back in this stagnant economy. There's some things that bear repeating. On page, I believe, 2. The economy appears to have been growing during that time frame at or below its long-term trend. Continued improvement in the job market is likely to require stronger growth in final demand and production. Notwithstanding the better recent data, the job market remains far from normal. The unemployment rate remains elevated. Long-term unemployment is still near record levels, and the number of persons working part-time for economic reasons is very high. Go on. The fundamentals that support spending continue to be weak. Real household income and wealth were flat in 2011, and access to credit remained restricted for many potential borrowers. Consumer sentiment, which dropped sharply last summer, has since rebounded but remains relatively low. Now, 2 questions, and then I'll be quiet and listen. The first is, in terms of the credit still not getting to potential borrowers, what specifically do you think the reason for that is? And what do you think can be specifically done about it, if not by you? I can understand why you can't discourse on that. And finally, my concern is that, just a question about how this operates. It says here on page 6, the target range for the federal funds rate remains at 0 to 0.25%. Now, when that type of rate remains in effect, does that have an effect on the personal savings interest rates that individuals who bank get? And if that is the case, that somehow that, let's say, stops them from getting a higher rate of return, would that not constitute them essentially subsidizing the operations to try to get money to, say, the banks or to other people who are still not giving the credit, which then leads to the horrible things that I started off my remarks with?
Well, on the latter point, we are certainly paying attention to the effects of low interest rates, not only on savers, but on other financial institutions and the like. The banks complain about the low interest rates. They say that that reduces their net interest margin, so it's not a profitable thing from their perspective. I would say from the point of view of savers, though, for most savers, I think on average something less than 10% of all savings by retirees is in the form of fixed interest instruments like CDs. Remember, people also own equities, they own money market funds, they own mutual funds, they have 401ks and a variety of things. And those assets are assets whose returns depend very much on how strong the economy is. And so in trying to strengthen the economy, we are actually helping savers by making the returns higher, as we can see in what's happened in the stock market, for example.
Yes. Excuse me, but that's a very important point. So I personally don't subscribe to the fact that just because it's 10% that would mean it was okay to have their rate of return artificially lowered. And I think that what you're saying then is that, yes, they are subsidizing this, but in the long run it's better for them because you believe this will lead to economic growth. Although, again, and we'll get to the second part of my question, that very much remains in doubt, doesn't it?
Well, the economy's been recovering, and I believe monetary policy is set appropriately to help the economy recover. Again, you can't get good returns in the economy unless you have growth. The other thing that we're doing, as you know, is we have set an inflation target, and we are committed to keeping inflation low and stable, and that also, of course, is good for savers because it's the inflation-adjusted return that matters in the end.
If I can, and we can skip the first part of the question because they're interrelated. So in short, it's almost as if you've decided that you're going to invest what their potential interest rates return would have been into your recovery for the economy. And again, it may be recovering, but by your own admission, it's either at or below long-term trends. We still have trouble getting money down into the hands of people for credit, into the hands of people who can grow this economy and get jobs back. And the long-term prognosis is not particularly good for unemployment rates dropping anytime in a precipitous fashion anytime soon. That doesn't necessarily sound like a very good investment if I'm saving and you're spending my money on your recovery.
We're not spending anybody's money. It's arguable that the interest rates are too high, that they're being constrained by the fact that interest rates can't go below zero. We have an economy where demand falls far short of the capacity of the economy to produce. We have an economy where the amount of investment and durable goods spending is far less than the capacity of the economy to produce. That suggests that interest rates in some sense should be lower rather than higher. We can't make interest rates lower, of course. It only can go down to zero. And again, I would argue that a healthy economy with good returns is the best way to get savers, get returns to savers. On providing credit, I guess I would just make one observation, which was the news this morning that bank lending increased last quarter at the fastest rate since the recession.